US payrolls data. Is it a green light for the Fed? Welcome to Market Insight. I'm David Pollard. Treasury yields and the dollar fell today after the release of November payrolls data. Bond markets apparently seeing little reason in the numbers for the Federal Reserve to pause its rate cuts at its December 17th to 18th meeting. Well, joining me now is Aaron Anderson, Senior Vice President of Research at Fisher Investments. Welcome, Aaron. The headline number actually came in at 227,000, slightly hotter than expected. So what is it that has cooled nerves over the Fed?
Yeah, well, first, nice to be with you again, David. Yeah, it was actually a very healthy number. I wouldn't call it spectacular, a little bit ahead of expectations. Certainly, it says that the disappointing data from last month was heavily influenced by climate, hurricanes specifically, and by some strikes here in the U.S., specifically with Boeing. And I think what you saw here was a nice rebound back to normalization. So I think it's a bit of a relief for folks to say, well, that was indeed just an anomalous month, and now we're back to a more normal trend. Certainly, it also suggests that some of the worries about the labor market over the summer, which got to be fairly intense there for a while and led to a lot of market volatility, those probably were a little bit of an exaggeration as well. And so I think what you're seeing with the general economy and what you're seeing with labor is that it's slow and steady, but actually reasonably healthy. And for the Fed, I think it means that they can still take their time in cutting interest rates. Clearly, there's no desperate reason for the Fed to be aggressively cutting interest rates here. But to the extent they still view themselves as being in restrictive territory, there's not much reason for that either. So I think this is an all clear for the Fed to just do what they might be doing otherwise and shouldn't really influence their plan too much.
So staying with the labour market for a moment, where are the strengths, where are the cracks in the jobs market? And despite what you say about it being healthy overall, could it actually be cooling at all?
Yeah, well, in terms of this is a bit of a hard number to interpret where the strengths and the weaknesses are, only because you are seeing those rebounding effects. And so you did see a pickup in industrial jobs. I think a lot of that was tied to the strikes that I mentioned. I think the more persistent strength continues to be in services. So whether it's in things like hospitality, whether it's in areas like healthcare, those have been far and away the strongest parts of the market, whereas manufacturing has been a little bit weak. Interestingly, government jobs picked up quite nicely. I don't know that that's sustainable. That tends to be a little bit more volatile, but I think you're continuing to see this divide between strength in services and a bit of weakness in manufacturing.
And looking at the Fed and the inflation outlook, we have a threat of tariffs under Donald Trump, possibly mass deportations, both of which could prove inflationary. Could inflation yet come back to bite the Fed and the US consumer?
I'm a little bit less worried about that. I mean, one, I just think the presidents generally aren't the primary force that drives inflation. I suppose I subscribe a little bit more to the monetarist view of inflation, too much money chasing too few goods and services. And I don't think we have a problem with either right now. You're actually seeing money supply flat to contracting a little bit. And we don't have any of the supply chain issues that we have when inflation was getting real intense back in 2022, as an example. And while you might get a blip here and there from things like tariffs, I think there's a lot of unknowns as to what the tariff picture is going to look like. I know there was a lot said during campaigns, but campaigns are campaigns. Usually most campaign promises and or threats, as we're seeing here, aren't necessarily lived up to. Even since the campaign, you've heard from President Trump himself varying views about how tariffs might be applied and to what magnitude. So it's hard to say exactly what that's going to look like, but I think at most you could get a blip in inflation in certain goods, keeping in mind that most of what we purchase across the world, but certainly here in the US, is more on the services side of things. And even for the goods that we're buying, still a decent portion of that is produced at home. So I think tariffs probably have a pretty minor impact. To the exportation part of things, I think that's likely to be a very slow process. And again, there's a lot of uncertainty as to what that's going to look like. So I don't think of that as being a real significant inflationary force either.
But Donald Trump, of course, proving a tonic for Wall Street share markets and what's already been a spectacular year for US blue chips, especially for tech, of course. Have we seen the best of the rally for this year?
Well, we're getting pretty close to the end of the year. It's always tough to make short-term forecasts when there's only about a month left. But I will say, just seasonally, this tends to be a very strong period for the market. And especially in election year, the period between the election and the end of the year tends to be quite strong. And so I wouldn't chalk that all up to a reaction to Trump winning necessarily. I do think just the clarity that comes along with getting the election out of the way is a reason that this period tends to be fairly positive for the market. And so I hate to make short-term predictions, but certainly I think there's a lot pointing towards this bull market continuing. Exactly what that looks like for the next several weeks, I'm not sure. But in terms of maybe a little bit of a longer-term outlook, I think we are still in a fairly favorable position. Just citing some of the labor market data today or other economic data, it seems like the economy is doing well. Certainly corporate results have been very, very good. Some people are going to like and some people are going to dislike the political situation, but I think it's fair to say globally, we've been through one of the most tumultuous political periods we've ever seen. That's still ongoing a little bit in France. Maybe you could argue in South Korea. We've been through the US elections. We've seen it in the UK. We've seen it in Japan. Just a whole lot of political change. But in my mind, what that means is that we're going from a period of fairly high political uncertainty, probably to less. Not that all the uncertainty is going away, but I think as we get further and further into these new administrations, we know more and more about what they might do or not do. And I think that increasing clarity is a good thing for the market. And so a decent political backdrop as well, although there are some risks there. And then investor sentiment still doesn't look far too optimistic to us. I mean, I know people point to the valuations of US stocks or enthusiasm about AI or what's going on with cryptocurrencies maybe as signs that sentiment is getting to be overheated. But I think there are plenty of parts of global equity markets where that's not the case. So I think that's a pretty good combination of decent economic backdrop, decent political backdrop, and room for sentiment to continue improving from here.
So if, with all those uncertainties and all those variables, an investor were to ask you for your top guidance for the next year, what that would be, in just a couple of sentences, what would you say to them?
Yeah, I think this is a period where, the bull market is most likely to continue. I don't think we'll necessarily get the rip-roaring returns that we've seen over the last couple of years, but I think there's plenty to support the ongoing bull market from here. And I think in terms of where investors might focus, I think it's very likely you continue to see a broadening out of leadership. Already for a while, it hasn't been all about the Magnificent Seven. You've seen more and more participation from different parts of the market. I think that probably continues.
Okay, Aaron Anderson of Fisher Investments, many thanks for sharing your thoughts with us today. That is Market Insight. We have more videos on Reuters.com.